Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to go through, our normal, what's happened with the numbers on a summary level. Then we're going to go deeper into U.S. activity, what's happening around the U.S. on the demand side, and then go abroad and look at OSPs. Obviously Saudi came out and raised prices for some, cut prices for others. We want to look at what are the implications, and then looking at exports from the U.S. and what is demand storage looking like around the world. So one of the things that we want to talk about briefly in segment one is just what are some of the summary level points. And here we had a small draw in crude, much less than what expectations were, and then we had some decent builds across gasoline and diesel. Now, when you look at what happened in terms of demand, we had a fairly sizable drop in diesel demand, which again I think is more of a timing delay. We should get a snapback. And then gasoline had a little bit less of a bounce than what I was expecting. And you're starting to see, again, this slow grind lower in terms of activity as we go into the end of the year. And obviously it's very seasonal. The seasonality continues to be a key component to it, but especially when we're talking about jet fuel. One of the things that we talked about in March and April, when there was this assumption that everyone was going to get vaccinated and go flying all over the place, our view was like, look, things are going to get better, but they're going to still be below 2019. And you're going to see normal seasonal moves up, seasonal moves down, but it was just going to be at a 500 to 800,000 person a day reduction versus what is normal. And, so far that came to pass. Just like the EIA came out and said that the production's at 11.7 million barrels a day. And for those that have been watching us, at the beginning of the year in March, we had said that we were thinking 11.5, 11.7, but then as we got closer and closer to the end of the year, we had tightened that up to 11.6, 11.7 million on the exit rate. So again, right in line with where we were thinking, on the back of 275 frac spread count, frac spreads operating. We were assuming 275 was the high level. We got to 274, and now we're going to start to see a slow drift lower. But again, these are just some basic things that we're always looking and talking about. And we'll cover some of this in the EIA show, some of it in the frac spread count show. But these are some of those key components when we're looking at making these projections, trying to look forward instead of, because all of this is doing on the EIA show, a lot of the data is really last week's data. So we want to take last week's data and bring it up to speed with what do we know so far, and what are the trends doing into the next few weeks. So this is just looking at total oil products and oil and product stocks. We want to look at the two different pieces. So when we look at total oil and product stocks here, you can see that we're just below the average that's being used between 2017, 2019. It tightened a little bit. It narrowed from a shortfall of 29.8 million to 22.9 million. So again, you're starting to see a little bit of that come back. And that's really, when you look at total crude stocks, land and floating, it's important to look at what is happening right now. And when you look at where things are, there's a little bit of a surplus that remains, but there's also a lot of crude that has gone in motion. And that just means that what is crude in transit? So we've seen some crude go from crude storage to now crude in motion. And that is going to, again, bring that down. But then when it shows up at that location, you'll see that come back up. And we still see the floating side remaining elevated as total oil product stockpiles. When you look at the deficit narrowed from 33.2 to 24.3, and we continue to see that deficit narrow on the product side, because this is the period of time when you see oil runs starting to increase along seasonal lines, and then that will reduce some of the oil on land and increase stockpiles. So that's why we always like to look at everything as an aggregate to understand what's happening. Then when we look in the U.S. weekly import of gasoline from Europe dipped through December 2nd. But it didn't dip too much. It's very much, very close in line to the 5-year average, just 49,000 barrels a day below. And we just think it's going to go back and forth, but we do see a little bit of a tick higher in terms of gasoline flows. So that'll be something to watch into the next few weeks. Now, when we look at land storage, because the land side looks better than the offshore side, which is why we always like to look at both. The land storage total, you can see that here with the deficit widened from 42.4 to 48.9. West of Suez continues to be fairly flat. Deficit narrowed slightly from 33.4 to 32.1. We have the U.S. that's seeing a bigger increase in what is floating storage because Pad 3 is, as we talked about, the liquids tax is trying to push some up in Cushing, keep some offshore, and then managing flows to make sure that they're not paying too much in taxes as we come to the end of the year, which I think is going to be an important piece. East of Suez has gotten much better. It went from a deficit of negative 10.4 to negative 16 million barrels, and that's something on the land side where that's where all of this crude is in transit to. So we will start to see that adjust upwards in terms of where some of these flows are going, because we like to look through the whole supply chain of where was the crude being produced from? What is the loading schedule? Is there stockpiles onshore, offshore at the production locations? What is now in transit, and then what has shown up there? And we're trying to follow the whole stream to get an idea of not only what is happening right now, but what is also to come. And that's when we start looking at floating storage, where floating storage dipped a bit. So the surplus narrowed from 29.9 to 8.7. And that was all really driven by East of Suez, which has come back down. But again, we will see some of that come back up, but not a huge amount, just enough to kind of keep this level right here. While West of Suez has spiked, surplus narrowed slightly from 3.8 to 3.6. But we're going to continue to see some of this grind higher, especially in the Gulf of Mexico, as well as in Europe. So then when you look at December loading shipments of clean fuels from Asia to the Americas, increased to 270,000 tons from 70,000 tons a week earlier. And as we were saying last week, we expected to see a steady rise in terms of just looking at the arbitrage. The arb was open, so we will see additional capacity coming from Asia into the Americas, especially on the West Coast, with European imports of clean products coming from Asia slowing down a bit, just because the arb is a little bit tighter, and we already had a decent amount of cargoes coming through. We have seen that open up a tiny bit more, so we will start to see a little bit of an additional move. But again, it won't be like what we've seen through October and November. So then when we look at the activity, when we look across the areas of TomTom, Google Mobility, so here you can see North America had a big drop. For those that are unsure of why, that's Thanksgiving. So that has since popped back up right around where we left off. So really not too much of an increase or decrease, but fairly stable. Europe has had a nice recovery, maintaining an elevated level, while China continues to have a little bit of that flatlining that we were talking about. We're just getting closer to normal, but not really getting quite there. And we expect that to continue to happen throughout the coming weeks. Google Mobility, again, you saw the decline in Americas coming back up, still very stable. Then when we look at Apple Mobility, you're starting to see some of this rollover. But again, this is just a matter of timing. This is indexed to January 13, 2020. So you're still seeing some fairly stable moves. Then when we look at the EPA on Tuesday called for cutting biofuel blending quotas. And they're looking to do it retroactively through from 2020. Just to bring it down based on there's a lot of waivers that have been requested. So one of the things that they've talked about is rejecting the waivers, but then reducing the amount of compliance, when they're thinking, well, we'll reduce the amount people have to buy, which will bring RIN prices down. So you really don't need a waiver because the prices won't be as onerous. And now we're going into comment period. So it'll be something to look for as we go into looking at the US and what is happening there. For 2020, the EPA is taking the step to reduce the total quota to 17.13 billion gallons from a 20.09 billion target established in December of 2019. As much as 12.5 billion of that could be filled with conventional renewable fuels such as ethanol. By reducing the 2020 quotas, the Biden administration could ensure refiners don't deplete a stockpile of previously generated credits. So again, there's some of those different pieces, and we'll talk about that a bit more in segment 2. Now, when we look at crude stocks, there was a small draw of 240,000 barrels. That brings us to, we're 51.7 below the 5-year average. And you can see that the builds were the largest in Pad 2 with a build in Pad 2 of 1.12 and Cushing of 2.37. So it's when you look at Pad 3, small build of 790,000 barrels. Again, that's where they're trying to manage it the most. And then a small draw from in Pad 1 and Pad 5. But those are very much timing delays, and we do expect that to stay fairly stable. We don't expect huge builds. And the one that we're going to watch really is Pad 3 in terms of where is Pad 3 and where is Pad 2 as they try to manage some of that flow. Then once we factor in the SPR, we had a drop to of 1.93 million, which again just goes into commercial storage. We're starting to get some bids from some international refiners for the SPR release that was previously announced. We'll have more on that as they start to assemble because bids are coming due for who wants to take some of that crude. As we said before, production is up 100,000 barrels, went to 11.7. We expect that to stay through the end of the year. This is just Gulf of Mexico is now fully back online, or mostly fully back online. And then we had that growth that we were talking about within the onshore side. So now when we look at runs, runs had an increase of 1%, went from 88.8% to 89.8%. So you had an increase of about 153,000 barrels. When you look at where some of this happened, it was Pad 2 that had the largest increase, up 184,000 barrels. And then when you look at the Gulf Coast, small drop of 65,000 barrels a day. We expect some additions as we go through the end of the month, or end of the year rather, where Pad 3 will continue to see a grind higher. As you look at the run rates of 89.8%, which is just 10 basis points below the 5-year average. And this is right in line with what we were thinking of, getting closer to that 90% and topping out around 92%. And when you look at this against the 5-year average, and then if you look at it against the 29-year average, things are fairly consistent. Now, when we look at imports dropped a small 105,000 barrels a day. That's 786,000 barrels a day below the 5-year average. And the biggest drop was caused by Pad 3, again, that management side. And we saw the big increase in floating storage. So this is just a timing delay. So those imports will reverse this week going into next week. Pad 2 had another increase of 243,000 barrels a day. Remember, Line 3 is fully operational. And you also had a lot of flooding issues. And that's just getting crude from the Canadian fields to the coast, which has then pushed down some differentials, which has then made it cheaper and increase the ability to pull down into the U.S. That is something that is starting to normalize. So we'll start to see this adjust a bit. But again, we still believe that you'll have an excess amount of crude coming from Canada into Pad 2. And then when you look at Pad 5, there's a steady grind higher. And this is just, again, those timing delays. And we'll talk about what that means, especially on Pad 5 or the West Coast in segment 2. Then when we look at implied demand, gasoline had an increase of 167,000 barrels a day. We were expecting a little bit more of a pop and just above about 9.1 before we started to see that grind down. This could mean that we have one more day that's closer to 9 million before we get a move closer to about 8.7 to 8.8. Distillate had a drop of 631,000 barrels a day. We were expecting a little bit of a bounce. So again, we just expect to see a bigger makeup because this is just as much timing delays as anything else. Jet fuel, as we said last week, the number seemed a bit high. So we were saying that there should be a makeup number, and here's your makeup number. So when you average it out, we're right around that 1.4 or 1.5, which we think is going to be consistent going into the end of the year. And then propane had a small drop of 58,000 barrels a day, but that's still 153,000 above the 5-year average, which will remain the case, even though we have gotten a bit warmer in the region. And then European refined fuel exports to the Americas are likely to rise towards the end of the month. So these are going to be some things to watch as we go into the end of the year, just given some demand has come down a touch in Europe, not all that much, even though Omicron is a thing and it's constantly in the headlines. We're still seeing people that don't that are adjusting slightly, but again, not all that much. Now, when we look at oil inventories, excluding the SPR, as we were saying last week, we expect it just to go sideways. We don't expect much of anything otherwise, and that'll make the comps a bit easier, as you can see that dip in 2017 and 2019, as we expect this to steadily go to the sideways pattern. While days of supply for crude are following the 2015 levels, and the only two times that they were higher was 2016 and 2020. And again, we just expect it to be fairly stable versus how it was in 2015 and 2019, as we do get a steady grind higher in refinery throughput. Now, when we start factoring in crude oil as well as products, we're starting to get that upward momentum. And as we were saying, we expect it just to continue to grind higher. Oil draws will be smaller than I think what expectations were, and then you'll continue to see that crude get turned into product. And then because we're focusing more on diesel and that heating oil side, you inherently throw off gasoline, so that'll increase gasoline builds, and then you'll also see builds on the disty side, which will keep grinding that back up. Again, very much seasonal norms. Then when you look at gasoline storage, here's that as we kept saying, we expected to see that rate increase. We expect this to continue to go back up very much in the seasonal fashion. It just started later, and based on what we're seeing, we don't see that rate really accelerating to close the gap. It's just going to continue at this rate into year end, which will put us pretty close to where we were on the exit on 2017. Now, when we look at distillate, we're starting to see that move back up. This will continue to grind higher, and we should get close to that 29-year average over the next 3 weeks, just given where we are on refinery utilization rate. Some of the slowdowns on exports, we don't see exports picking up all that much. As we were saying last week, we thought that the drop was really weird. Now we had a huge makeup number. So it's just, as we go forward, we expect this to be fairly stable, which will put builds back towards that normal level. Then when you look at jet fuel, again, it's going to be a matter of managing jet kerosene and the disty pool. So there's enough to go around to really adjust how much is going into jet, how much is staying in the diesel cut. Now, when we look at the curve, at the futures curve, you can see that we're starting to dip down on the front end. Time spreads are starting to weaken. We should start to see this go. I wouldn't say go really into full-on contango, but at least see the front end of the curve start to flatline a bit more. And one of the things that we've been saying is that we were more bullish the back end of the curve, especially when you look at kind of where a lot of this starts to play out in terms of investments. And you're seeing that really hold now above 60, close to about 60 to 61, which still supports investment, which we've seen announcements from the UAE, Iraq, and obviously throughout Latin America, especially Guyana. But when you look at just the front months, we're above 70 through June of next year, and then we're above 65 through the end of 2023. So still in a fairly comfortable level when you're looking at U.S. Deployed capital as well as global capital. Now, when you look at COVID, cases continue to rise, and it's just as you see Omicron come through. But again, it's a coronavirus, and when do coronaviruses do best? In the winter. So I don't think there's anything too crazy to look at when you're seeing this steady increase, especially in the colder countries, as we continue to see it in the US, in Europe. The UK has flatlined. Germany had another increase. We expect that to continue, where we had another grind higher in Vietnam and South Korea, putting in a big number. But again, nothing, I think, crazy when you're looking at what is happening on case count versus hospital count, where so far things still remain fairly stable, which just means that it supports a bit less of severity in terms of COVID, as well as the success of some of the vaccines in keeping some individuals out of the hospital. Then when we look at pad 3, as we were saying previously, we think this goes a bit sideways from here. We don't see, they're not going to send this higher because they want to try to keep it as low as possible. And here in 2019, you saw that big drop off. We just think it'll continue to drift a little bit lower, and they'll try to keep this as balanced as possible as we head into year end, which is going to leave more in Cushing. So here, as we were saying, we expected to see an acceleration into year end of crude being stuck in Cushing. And this is a mixture of production starting to go up, as well as, or I should say peaking, as well as pad 3 just leaving more within pad 2. So then when you look at Gulf Coast, here you can see the floating storage that we were talking about moving back closer to the 5-year average. We don't think it gets back to the 5-year, but again, just stays within the base of that cloud, just below the 5-year, but again, not at the lows that we've seen over the last few months. Then when you look at operating rates, especially for refiners, this is looking at the 29-year average. So we're just below, but we're going to continue to see that steady grind really within the normal framework. We will get another little increase and then a bit of a pause as we go into slower months. And then you'll get a drop for Christmas, and then we'll see that remaining surge as we go into January, getting us to that 92%, 93% utilization rate. So something very, I would just say, seasonally normal. So that's what we have for that overview. Now in the next segment, we're going to go deeper into the U.S., what's happening in terms of storage as well as demand, and where do we see things shaking out into year end.